Hey traders, this is Blake Morrow with Trader Summit, and I have with me the dynamic duo of Michael Brown from Trader X, and I have Mr. Dick Matthews of Pardus FX that happen to be blessing us together today on this show. So good to see you, gentlemen.
Good to see you, Blake. Thanks for inviting us once again in person at last. It's nice to be in the same room. Shame you're not with us.
Yeah, I know it'd be great. I would sit there and hang out, and we'd go grab a pint afterwards. But unfortunately, that's just not going to be the case with me here in the United States. But hey, it's great to see you both, and it's like a very obviously there's a few things happening around the world right now that we probably need to discuss, and it's good to have you both here and your expertise. Let's start off with what's happening in North America and the banking crisis. What's the view from the other side of the pond, looking at what's happening with Silicon Valley Bank and the other banks as well? We can start with you, Michael.
I mean, I think it's interesting to look at this from here rather than where you are, right in the thick of the action. I think I would wager that probably 95%, and that's a conservative estimate, of the UK population and probably the UK financial services industry had never heard of Silicon Valley Bank until probably last Thursday morning when all of this started blowing up. I think the way I look at it, and your view may be different because you're much closer to the action than we are, is this is a regional bank. This is a relatively small bank in the United States that had very, very poor risk management policies in place and got itself massively concentrated into one sector. So, of course, when rates start to rise, the value of its portfolio of bond holdings falls, and the tech sector struggles and, of course, tries to take some of their deposits out of the bank at a faster rate than they've been expecting. They haven't got exposure to anything else to net that off against. So in some ways, and of course, hindsight's a wonderful thing, it's perhaps no surprise. But I guess the blessing within all of this is it should be relatively confined to these banks that have a high concentration towards one sector and slapdash risk management policies. It's not something that we saw in 2008, for instance, where it's a systemic issue. This is much more of a sort of limited scale. And I think that's why you're seeing markets, by and large, of course, we've had some incredible volatility of late that we'll dig into, but why we're seeing, by and large, markets somewhat move past these issues and actually start to focus on the broader macroeconomy, sort of safe in the knowledge that actually the broader and wider US banking sector is safe, touch wood.
Yeah, that's, some great points. And I think we will touch on here in a little bit about, maybe what the other implications might be that might affect us globally, especially as traders. But Dick, what do you have any thoughts there with what's happening with SVB?
Yeah, I was really sad to see it go, especially it had such good diversity procedures in the board. Unfortunately, we weren't so good at hedging their risk. Yeah, I was thinking about the first time I saw a bank go under from basically borrowing short and lending long, was way back when I first started in the mid-70s. A bank called the Scottish Co-op did exactly the similar sort of thing. And banks just never learn. Savings and loans, it's just almost an occupational hazard. I think the Fed's acted quickly. My concern or my interest really was how the rest of the markets reacted. Oh, the Fed's going to ease now. They're going to pump money back in the market. Yeah, yippee, great. They're not. The Fed are still going to do 25 basis points, if not 50. I think 25 is nailed on.
25, I think.
If they don't, you've got a real big problem with hyperinflation.
Sure, and that brings up another point. And as we go into a week where we're faced with the ECB this week, and then obviously the Fed's coming up right after. So let's talk about the implications there, the unintended consequences, if you will. We can start with the Fed, and Dick, let's expand on that. There's a lot of reports out right now that are saying that the Fed's not going to be able to raise 0.5%. They're going to have to raise at least a quarter, but they have to raise because of the optics of what it would look like, and it'd send a message that we have some bigger banking issue.
Yeah.
Are you in that camp, and do you feel that that the Fed would be making the right move by if they were really not going to go 50 and just go a quarter, do you think they should actually be going 50?
The CPI number today was relatively okay. There were one or two hot bits in it, wasn't there, in the rental sector and the cost of homes. The cost of rentals. I would think they've got to go 25 or go for a quarter. The danger is, as you rightly say, if they don't do anything, people are going to say, boy, there's a big problem out there. There's a bank who's in real big problems. So I think they've got to go a quarter. I'm not sure whether it demands 50 basis points, and maybe it's a little bit of a wake-up call to the system starting to creak a bit. Looks like the economy's slowing down. And whether SVB were the canary in the coal mine, I don't know. So I back for 25. I think that Jerome Powell will come out fighting, and the threat will be there that we ain't finished yet. I still believe higher for longer. And anyone thinks they're going to ease off this year, I think some cloud cuckoo land, unless there's a black swan lurking, which we don't know about.
Yeah, that's interesting. Go ahead, Michael.
No, sorry, Blake. I was going to say I'd agree entirely with that. I think if the Fed, and we were talking about this earlier in one of the City of London's drinking houses, I think if the Fed were to do nothing, then that's just going to make the markets panic, very much in the same way as we saw at the start of the pandemic, when markets really started to wake up to the threat of COVID and it being a financial issue, was when the Fed did that emergency rate cut all the way back in March of 2020. And I think if we saw them stay on hold, or even as Nomura are saying they were to cut rates next week, we'd have a similar reaction. Everyone would, rather than reassuring the markets, everyone would actually start to scratch their heads and go, which of the whales is in real trouble? So that's clearly something that the Fed want to avoid. But I think what's very interesting to me, and that this is getting into the weeds of monetary policy geekiness here, so do forgive me for a second, but the way that you can have a kick at the corners, the way that the Fed have structured the statement around the new liquidity facility that they've provided to backstop banks, and the way that that facility is constructed, I think they're trying very hard to separate their two functions, of course, financial stability and monetary policy. And I think by doing that, what they're saying is, we are going to backstop the banks, yes, but at the same time, this is not going to stop us from raising rates, continuing quantitative tightening, continuing to tighten financial conditions in an economy where inflation is, 6% as we saw today, and needs to come lower very, very quickly.
Great points. And, and that brings us really to like our next point, tomorrow, or is it tomorrow or Thursday? I actually believe it's Thursday. Yeah, we have the European Central Bank meeting, and the euro has been surprisingly well bid going into this meeting. I mean, you see the euro where a lot of times when there's some risk aversion, as most traders know this, when there's risk aversion, you see people panic or like in this case over the weekend. The dollar tends to catch a bid. We see the euro come down. We see the cable come down. We see a lot of the Antipodeans. They drop quite aggressively. But that really hasn't been the case with the euro this week. So Michael, since you were just discussing central banks and the Fed, how do you feel about the ECB this week as we're faced with the ECB decision?
Yeah, I mean, just a sort of broader point on what you were saying first. I think, you're right. Normally in times of risk aversion, the dollar rallies and there's nothing you would want to hold other than cash dollars. I don't want to use a sort of central banking phrase, but this time is different. You don't normally have a situation where the market is fleeing to safety, but the S&P is down just 0.2%, and the 2-year yield rallies 60 basis points in a day. If yields are falling by that much, I think it's the biggest 3-day fall in the 2-year on record. There's absolutely no way the dollar is going to find any sort of demand in that kind of situation. So the move higher that we've seen in the euro, I think, is more a function of the dollar rolling over rather than anything specific to the common currency. But what I would say, just to get back to your point in terms of the ECB, what do we expect? Well, I think they're going to make a pig's ear of whatever they do, let's be honest, given that it's Christine Lagarde giving the press conference. They'll still hike by 50 basis points, I would expect. Markets have repriced that in a dovish direction of late, but I still think 50 basis points is locked in. The real question is, what do they say in terms of their guidance? And I think the Hawks are going to be a bit disappointed. I think the Hawks will be looking for a concrete commitment to continue raising rates as we move through into the latter part of spring, I don't think we're going to get that. I think we're going to get a much more data-dependent approach. But the ECB have got a real problem on their hands because in the US, of course, inflation is still too high, but it's trending lower. In the Eurozone, core inflation is at a record high of 5.6%, but it's still heading north. It hasn't shown any signs of peaking yet. At the same time as growth is, well, momentum in terms of growth is slowing rapidly, and the PMI numbers are not exactly great. So the ECB have got a real communications challenge on their hands, just in terms of what's going on domestically. Throw SVB into the mix as well, and I think the Hawks are probably going to be in for disappointment come Thursday lunchtime. What are your thoughts?
Yeah, I broadly agree with you, Michael. I think that the euro is probably getting near the top, 108 and a bit maybe. Yeah. We're going to see against the dollar. My interest rate concern is that you've seen a problem in the UK with LDIs and the gilt market in the UK and pension funds. You've seen a problem in the States caused by rising interest rates very sharply. You haven't seen it in Europe yet. And to me, Europe has got by far the weakest banking sector out of the three countries or the three zones we're talking about. And I would be at all surprised to see some sort of problem crop up in the Eurozone pretty damn soon. And I'm not talking about a Swiss bank. I think a southern,
them as well,
but I think it's more likely to be a southern European friend of ours who has problems.
I know, and I know there's some talk about maybe some M&A talk as well in the European banking sector. So should be interesting to see as yields continue to move higher. And I want to really end with next week we have the Fed, and I know it's a little early, and it's as we're finding out in our markets, things can change quite a bit in just a few days. So I don't want to hold your feet to the fire here, but Dick, I've already got your thoughts, but I want you to expand on them. You don't think the Fed is going to be in the position or going to want to cut rates, and I think the market's still being a little stubborn and trying to price in rate cuts sometime in this year. What's your reasoning?
Do you know that they've been trying to price in rate cuts for the last 6 months, maybe a little bit more than that? Oh, the Fed's going to pivot. The Fed's going to pivot. And they've been coming out with this BS for months now. And all the Fed's going to pivot. And now they've got an opportunity. They've got to cut rates. They've got to cut rates. Why? You've still got inflation, which is too high over there. 3 times their target, roughly 3 times their target. They're not going to cut, they're going to stick, and they're going to stick at 25 basis points, because in a way the problems with SVB has helped them a little bit. It's tightened policy indirectly for them. I think they're going to cut, and J Power is going to turn up.
They're going to cut.
They're going to hike by 25.
Okay, yeah, I was glad you caught him, Michael.
Yeah, to see if you're paying attention. They're going to hike by 25. And I think J Power's going to come out fighting and say, hey, we're not in the mood to cut, and inflation is still too high.
All right. Well, Michael, final thoughts here on the Fed. Your trajectory this year for what the Fed's going to do. What are your thoughts there?
Yeah, I mean, this is going to make for a very boring video, because I think we're both in agreement with each other for most of it, unfortunately. I agree with Dick. This is like the 2010 election. Yeah. Remember that? All the UK politicians. I agree with Nick. I agree with Dick in this case. I think they go 25. I'm not sure Powell will come out swinging at the press conference. I would say that. I think he may take on a bit more of a cautious tone than we heard last time, because I think if you think back to the last press conference, we had a resolute commitment to continue raising rates, which we're obviously expecting, but also maybe a little bit of a premature victory lap where Powell was saying that the disinflation process is already underway. And of course, markets momentarily ripped higher. So I think Powell will be a little bit more reserved than we've seen him of late. But I think the Fed will continue hiking. They'll probably get the terminal rate, I still think, will get to around 5.5%. I think the ECB will continue to raise rates into the spring. And I think the Bank of England, just to broaden your question out, there we go. They'll go exactly. They'll go 25 next week, and that will probably be it. And why would you want to be long sterling in that sort of an environment?
Well, I'm going to disagree with Michael there. I don't think the Bank of England will hike.
Whoa.
You reckon they'll hold?
I think they'll hold.
Well, then we're going to leave it at that, and we're going to leave everybody hanging on a wire because the Bank of England is going to be the one to watch with these two gentlemen. Now, really quick, I just want to say, I've known both of you now for quite some time. What's the best way to follow each one of you via social media? Let's start with you, Michael.
Yes, Twitter, Mr. M Brown, or TraderX official, of course, and also go to traderx.com because there's a whole host of content on there, and you'll see the good man Blake Morrow himself on there as well.
I love that, and I love the competition that we have there. Dick, what's the best way to follow your work?
Well, ours is better, so
I'm not joining into this argument. You can follow me on Twitter, which is @DickieMatthews. Or watch me on PardusFX.com where I post a daily comment.
Awesome. Well, gentlemen, I want to thank you both for spending your time with us. If you like what you see here, make sure you give us a thumbs up, especially for these two gentlemen, and also subscribe to the channel. Thank you so much, gents. Good luck next week, and good luck at the ECB tomorrow.
Cheers, Blake. Take care, mate.
Cheers out. Bye.
Thank you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.